Let me be real with you for a second. Right now, as you're watching this video, there are people absolutely panicking. They're refreshing their brokerage apps every 5 minutes, watching their portfolio go red, and they're making decisions that they are going to regret for years. And then there are a completely different group of people. Quiet, calm, almost smiling, who are doing something that the first group thinks is absolutely insane. They're buying. And by the time this video is over, you're going to understand exactly why, and you're going to know how to think like that second group every single time the market decides to throw a tantrum. So the stock market just crashed, or maybe it's crashing right now as you're watching this. Maybe you woke up this morning and saw the headlines and your stomach dropped. Maybe you opened your investment account and the number staring back at you was a lot smaller than it was last week. I get it. That feeling is real, and it's uncomfortable, and it's completely human. But here's what I want you to hold on to before we go any further. A drop in the market is not the same as a loss. Say that again. A drop in the market is not the same as a loss. You only actually lose money when you sell. And that right there is the key that unlocks everything we're going to talk about today. Now let's talk about what actually happens during a market crash. Because most people have this backwards. When prices fall sharply, the narrative that takes over is one of doom. The news channels go into overdrive. Social media becomes a disaster movie. And suddenly everyone's an expert telling you to get out before it gets worse. And what does the average retail investor do? They listen. They sell. They lock in their losses. And they sit on the sideline in cash, waiting for things to feel safe again. And here's the brutal irony of that. By the time things feel safe again, by the time the news is positive, by the time people are excited about the market again, the prices have already recovered. You missed the entire rebound, sitting in cash feeling relieved. You bought high and sold low, which is the exact opposite of every principle of building wealth through investing. This is what Warren Buffett meant when he said, "Be fearful when others are greedy, and greedy when others are fearful." He wasn't just giving us a clever quote to put on a motivational poster. He was describing the single most powerful and psychologically difficult strategy in investing. Buying the dip. Buying when everything feels wrong, when the headlines are scary, when your gut is telling you to run, because that discomfort, that's the price of admission for generational wealth. Now I want to get into what buying the dip actually looks like in practice, because there's a right way to do this and there's a wrong way. And I see people mess this up all the time. The wrong way is to see the market drop and just throw all your money in at once because you think you've spotted the bottom. Nobody, and I mean nobody, can consistently predict the exact bottom of a market crash. Not hedge fund managers, not Wall Street analysts, not the guy on YouTube with the fancy charts. Timing the market perfectly is a fool's game, and the data proves it over and over again. The right way to buy the dip is through a strategy called dollar cost averaging, and it is beautifully simple. Instead of trying to pick one perfect moment to invest, you spread your purchases out over time. Let's say you have $10,000 you want to deploy during this downturn. Instead of dumping it all in today, you invest $2,000 every 2 weeks over the next couple of months. What this does is it takes the guesswork completely out of the equation. Some of those purchases will be at higher prices, some will be at lower prices, and you'll end up with an average cost that smooths everything out. You stop trying to be a market wizard, and you start being a disciplined, systematic investor, which is actually what builds wealth. Now let's talk about what you should actually be buying when there's blood in the streets, because this matters enormously. A market crash is not the time to go hunting for high-risk speculative plays. It is not the time to throw money at penny stocks or some tiny company you saw trending on Reddit. When markets crash, liquidity dries up, and the riskiest assets tend to get hit the hardest. What you want during a downturn are quality assets. Companies with strong balance sheets, consistent earnings, low debt, and real competitive advantages. Think about the businesses that are going to exist not just next year, but 10, 15, 20 years from now. The businesses that people cannot stop using regardless of whether the economy is booming or struggling. Those are the businesses you want to be buying when the market is handing them to you at a discount. Index funds deserve a special mention here because they are the most reliable vehicle for most investors to buy the dip effectively. When you buy an index fund, something like one that tracks the S&P 500, you're not betting on any single company surviving or thriving. You're betting on the overall market recovering, which historically, it has done every single time, without exception. Every crash, every correction, every panic sell-off in history has eventually been followed by a recovery and new highs. Every single one. That's not blind optimism. That's just what the data shows. Let me give you some historical perspective because I think this is where a lot of people find the clarity they need to actually take action. The 2008 financial crisis was one of the most terrifying economic events in modern history. The market dropped about 50% from peak to bottom. Unemployment was skyrocketing, banks were collapsing, and the sentiment was that capitalism itself might be broken. People who sold at the bottom in 2009 and waited on the sidelines locked in catastrophic losses. People who kept buying, who averaged in during those dark months, who held their quality positions through the fear, they were rewarded with one of the longest bull markets in history over the following decade. The same story played out in 2020 when the pandemic hit and the market crashed 34% in a matter of weeks. It was chaos. And yet, the people who bought that dip saw the market recover and then set new all-time highs within months. There is a pattern here, and it is remarkably consistent. Markets fall fast and they feel catastrophic in the moment, and then they recover, and they reward the people who stayed rational. But here's something I need to address because I don't want you to hear this video and think buying the dip is a magical guaranteed money machine with zero risk. It is not. There is real risk here, and managing that risk is what separates disciplined investors from people who blow themselves up trying to be clever. First, you should never invest money you cannot afford to leave invested for years. Emergency funds, rent money, money you might need in 6 months. None of that belongs in the stock market, and definitely not during a crash. Only capital that you can genuinely let sit and grow over a long time horizon belongs in this strategy. Second, you need to make sure your portfolio is diversified. Buying the dip on a single sector, a single stock, or a single theme is speculation. Buying the dip on a broadly diversified portfolio is investing. There's a big difference. And third, and this one is so important, you need to have an actual plan before the market falls, not while it's falling. Because when the market is crashing, your emotions are in overdrive, and you will make worse decisions than you would make sitting calmly at your desk right now. Write down your strategy. Write down how much you're going to invest, in what, on what schedule, and what your actual long-term goals are. Then when the panic hits, you execute the plan instead of reacting to the moment. This is what the most successful long-term investors do. They don't wing it in real time. They follow a system they built when they were thinking clearly. There's one more thing I want to leave you with, and it's about the psychological game that is constantly being played against you as an investor. The financial media, the market pundits, the social media doom scrolling, all of it is designed to get you emotional, because emotional investors make impulsive decisions, and impulsive decisions generate activity, and activity generates revenue for brokers, for media companies, for everyone except you. The moment you understand that, you can start filtering it out. You can hear that the market is down 20%, and instead of feeling fear, you can feel something closer to curiosity. You can ask yourself, what is actually on sale right now? And is any of it something I want to own for the long run? That shift in mindset, from fear to opportunity, is what separates the investors who build serious wealth from the ones who perpetually buy high when everything feels safe and sell low when everything feels scary. It's not about intelligence. Honestly, it's not even really about financial knowledge, although that helps. It's about emotional discipline. It's about training yourself to act on logic and long-term thinking instead of reacting to short-term noise. So here's where I'll leave you. The market just crashed. Or it's in the middle of crashing. Or it will crash again sometime in the future, because that's just the nature of markets. And every single time it happens, you now have a choice. You can be in the group that panics, that sells, that waits on the sidelines until it feels safe and then buys back in at higher prices. Or you can be in the group that sees the markdown, pulls out the shopping list, and gets to work. The second group has historically been right. The second group builds wealth. And with everything you now know, the psychology, the strategy, the history, the discipline, you have everything you need to be part of that group. If this helped you think differently about market crashes and investing, make sure you hit subscribe, because this is the kind of conversation we have here all the time. Drop a comment below and tell me, are you buying the dip right now? And what are you buying? I read every single one. See you in the next one.